Okay, welcome to this class. In our last class, we looked at indicators, the different types. We didn't go into details of how to use those indicators. You learn that as you begin to learn on your own. But now I want to talk about the different types of trading that people do. Uh, there is a trading that has to do with technical analysis that has to do with using indicators, and there's another one that has to do with not using any indicator. So if you are using indicators, it is called indicator-based trading. Indicator-based trading. You're trading based on an indicator, meaning, for example, you could say, I'm trading based off of, sorry, let's use Litecoin. Okay, so if you're trading based on an indicator, you're doing indicator-based trading, meaning your strategy will be that, okay, if price is above this indicator, this yellow line, I'm going to be buying. I'm going to be buying. You could also use an indicator that says, um, let's add another indicator. Okay. Now, I've added another indicator, this tiny blue line. Let's make it white so that it's visible. Okay, you could have another strategy that says whenever this white line is below this yellow line, I would look for selling opportunities. I won't try to buy. But as soon as this yellow white line crosses above the yellow line, I'll be looking for buying opportunities. I'll just buy and stay in the market until this white line crosses back below the yellow line. For example, if you are following that strategy, for example, you would have bought this market somewhere here. As it crossed, maybe you bought somewhere around here. Then you stay in this market until it comes down here, then you get out of the market. So you're not trying to reason what this candle is, what that candle is. You're just trading based off these two lines. When this white line is below the yellow line, you don't try to buy, you only try to sell. But as soon as the white line crosses above this yellow line, you're looking to buy. Now, that is trading purely based off an indicator, meaning you're not really looking at the candlestick, you're just following where the white line is uh, in relation to the yellow line. Now that's one. You could decide that, okay, to use another indicator down here called an oscillator. This is the MACD. So you could decide to say that, okay, whenever this um, blue line crosses over this red line here, you're going to buy this market, and you stay in the market until these two lines cross back below this zero line. For example, you say you would have bought here and you stay in this market until maybe somewhere, maybe when they cross back below this zero line. Now that is trading based of an indicator. Now that's indicator-based trading. The next one is what we refer to as naked charts, or not use naked charts, or naked trading, or pure price action trading. In pure price action trading, you're not looking at any indicators. In fact, in pure price action, indicators are a taboo. Indicators are seen as a deception. Indicators are seen as a problem. And the reason is because indicators might give you false signals, they might deceive you, they might be a form of distraction too. So in naked chart trading or pure price action trading, they make use of candlesticks as well as support and resistance zones and levels. So that's the only thing that they use. So in pure price action trading, they identify their levels, like I'm trying to do now, mark out their support levels. So they say if so they identify the trend of the market. Okay, this market is trending up. So they say, okay, since I'm trading price action, whenever price breaks through a support, that support becomes resistance, I'll look to sell. So in pure price action trading, as price goes up, forms a low, like we discussed the other time, a high. When they see this higher low and they get a good candle confirmation, a candle, so they look at different candles, bullish engulfing, harami candle, hammer. They, in pure price action, they learn the candlesticks and what each candlestick stands for. So they attempt to buy here. They don't need an indicator to tell them. They are making use of market structure. Price comes down here again, they buy. So they are not waiting for an indicator to cross or not cross. Why? Because sometimes when they are waiting for an indicator to cross, the market has already gone too far. So in pure price action trading, here for example, as market comes down, goes up, comes to an area of support, they'll look to buy somewhere here, then ride it up, maybe take profit here. As market breaks this resistance, comes down, they buy here again and ride the way up. So that's pure price action trading. Now, there's a third type that says, uh, okay, indicators are not completely bad. Indicators are not completely bad. In fact, indicators can help us point things that without them we might not maybe exactly see. But we're going to use, so we'll be using indicators, but we will not rely on any indicator. So those set of people might have indicators on the chart. They might have this same moving average, or let's say they have this moving average on the chart. Then they have an oscillator. So their strategy is simple. We are buying support and resistance in the direction of the trend, but we're only buying a support if that support is above our baseline. For example, so this kind of trading that combines uh, price action and indicators is called uh, assisted price action or filtered price action, meaning they're using price action quite all right, but they are not relying on price action alone. They are relying also, they are using indicators to form a confluence, meaning they won't just buy because prices are support. The indicators will tell them what support that is valid that they should be buying. So if price is above the yellow line, to them, that's an uptrend. So those are the kind of supports they buy. The support that is above the baseline. Like here now is a support, they buy this because it's above the baseline. They buy this. This kind of support, they won't buy it. They won't buy here because it is below the market baseline. Now, those are the three types of strategies that people can use in the market. Indicator-based strategy, completely naked chart of price action, then the final one, which combines indicators and price action. So as a beginner, you try out which one you think works best for you. Everybody, the people that use naked charts always say theirs is the best, that using indicators is a waste of time. Those who use indicators say that those who trade just on price action are not being sincere, that price action alone is not reliable. But the truth is, there is no single strategy that is 100% reliable or 100% accurate. You always have to look for probabilities, and meaning you look for a winning rate. It could be 50%, 50, 60%, 70% win rate, meaning you agree ahead of time that no single strategy will give you 100% winning rate all the time. If you can accept that, then you won't be insisting on what strategy is the best, whether indicator based or non indicator based strategy.